Every March, SCHD quietly fires companies and replaces them with better ones. No headlines, no news coverage. But this March, something happened that has never happened before in the fund's history. And if you own SCHD, this directly affects your future dividend income. And almost no investors are talking about it. To really understand what changed, let's look at one investor who's been watching this fund for years. Silas Graham has owned SCHD for 6 years, 44 years old, software architect in Austin, Texas, building his retirement one dividend at a time. Every March, Silas does the same thing. He pulls up the SCHD Reconstitution results the moment they drop. This March, Silas opened the results and saw something he had never seen before. 22 companies removed, 25 companies added, the biggest single reconstitution in SCHD's entire history. He understood immediately why this fund has outperformed nearly every dividend competitor for over a decade. Today, I am going to show you exactly what changed inside SCHD in 2026, what got removed and why, what got added and why, and what this specific reconstitution means for every dollar you currently have invested in this fund. Quick important note before we go further. Nothing in this video is financial advice. I am not your financial advisor. Everything here is for educational purposes only. Always do your own research before making any investment decisions. This channel covers the investment strategies and data that actually move the needle on your financial future. No hype, no speculation, just the numbers and what they mean for your money. Subscribe so you never miss a video. Now, let us talk about what just happened inside SCHD and why it matters more than most investors realize. Part 1. How the quality filter actually works. Before the changes, let us understand the system. Every March, SCHD runs every holding through a 4-part quality scoring system, each metric worth exactly 25% of the total score. Metric 1. Free cash flow to total debt. Is the company generating enough cash to cover what it owes? Metric 2. Return on equity. How efficiently is the company turning shareholder investment into profit? Metric 3. Dividend yield. Is the current yield competitive against the broader dividend universe? Metric 4, 5-year dividend growth rate. Has the company been consistently increasing its dividend over the last 5 years? Every single holding gets scored. Every single holding gets ranked. If your score drops below the cutoff, you are out. No loyalty, no exceptions. No matter how famous your brand, no matter how long you've been in the fund, the quality filter does not care about reputation. It cares about math. And in 2026, the math removed 22 companies and replaced them with 25 stronger ones. Part 2. What got removed and the number that explains everything. 22 companies were removed this March. Let me group them by what their removal means for you. The energy purge. 6 energy-related stocks were removed simultaneously. Before this reconstitution, energy represented approximately 20% of SCHD's total weight. 1 in every $5 you invested in SCHD was exposed to oil price volatility. After this reconstitution, energy sits at approximately 12%. That 8 percentage point reduction in a single day means SCHD is now significantly less vulnerable to the next energy crash. And energy crashes historically come without warning and hit hard and fast. The small financial cleanup. 7 smaller financial holdings were removed. Most were under 0.5% of the fund individually. You probably never knew their names, but the quality filter does not have a minimum size exception. If your metrics slip below the cutoff, you are removed regardless of position size. The consumer and industrial cuts. Several consumer and industrial names failed to maintain sufficient dividend growth or free cash flow metrics. The filter does not care about brand recognition. It cares about whether the numbers support a sustainable and growing dividend going forward. Now, here's the number Silas saw that made everything click. One removed stock had a payout ratio of 284%. Let me explain what that means. For every single dollar that company earned, it paid out $2.84 in dividends, nearly 3 times its actual earnings. How do you sustain that? You borrow, you drain your reserves, you delay investment in your own business, and eventually, something breaks. The quality filter caught a dividend that was mathematically unsustainable before it cut, before investors holding it individually had any warning. This is the most valuable thing SCHD's reconstitution does for investors that almost nobody talks about. It's an early warning system that removes financial landmines before they explode in your portfolio. Part 3. What got added and why it is an upgrade. 25 companies entered SCHD SCHD this March. Here's what those actually mean for your money. The healthcare upgrade. Two massive healthcare additions dramatically increased SCHD's healthcare exposure from approximately 16% to roughly 20%. United Health Group entered the fund, the largest health insurer in America, over 15 consecutive years of dividend growth. Abbott Laboratories also entered, over 13 consecutive years of dividend increases. Healthcare is one of the most recession-resistant sectors in the entire market. People need healthcare in recessions, in crashes, in pandemics. Demand does not disappear when the economy contracts. SCHD now has 4 percentage points more exposure to this demographic-driven sector. The technology infusion. 4 significant technology additions, each with long dividend track records. Qualcomm entered with 21 consecutive years of dividend growth, the chips inside most smartphones worldwide. ADP entered with 49 consecutive years of dividend increases, 1 year away from dividend king status. These are not speculative technology companies. These are profitable technology companies with decade-long dividend growth histories. That combination of profitability plus dividend growth is genuinely valuable in a dividend fund. The crown jewel addition. Procter and Gamble entered SCHD this March. 69 consecutive years of dividend increases, through every recession since the 1950s, through every market crash, through every financial crisis, through a global pandemic. 69 years without a single missed increase. Tide, Gillette, Pampers, Crest, products people buy in every economic condition imaginable. This single addition arguably upgrades the quality of SCHD's dividend growth engine more than any other change in this reconstitution. Part 4. What this means for your money. Here's what most SCHD coverage completely misses. The yield stayed at approximately 3.6%, essentially unchanged. Your income did not drop, but the quality of the companies generating that income just upgraded significantly. Here's the specific math Silas ran when he saw the reconstitution results. If you currently have $100,000 in SCHD at a 3.6% yield, you're generating approximately $3,600 in annual dividends today. SCHD has historically delivered approximately 10.6% annual dividend growth over the past decade. With the additions of Procter and Gamble at 69 years, ADP at 49 years, and Old Republic at over 40 years of consecutive increases, that dividend growth engine is arguably stronger after this reconstitution than before it. At 10.6% annual dividend growth, your $3,600 starting dividend grows to approximately $9,800 per year by year 10, $817 per month in passive income, growing automatically from a single investment without you doing anything. That's the compounding dividend engine that this reconstitution just upgraded. Now, here's the context most investors are missing completely. In 2025, SCHD returned approximately 4.3%, while the S&P 500 returned nearly 18%. Dividend investors questioned themselves. In 2026, year-to-date, SCHD is up approximately 12 to 15%, while the S&P 500 is down roughly 1%. The tables flipped completely. Quality dividend payers became the anchor during market turbulence, exactly the way they always have historically when growth stocks face headwinds. The trailing price-to-earnings ratio sits around 17 times earnings. The S&P 500 currently trades at approximately 29 times. SCHD offers nearly half the valuation of the broader market while generating growing income from companies with decades of dividend track records. That combination of value plus income plus quality is exactly what long-term investors should want during periods of market uncertainty. Part 5. 3 things to watch right now. Here are 3 specific things worth monitoring in the weeks following this reconstitution. Watch 1. The Q1 2026 dividend estimate. Current estimates point to approximately 25 to 27 cents per share for the first quarter. That would represent roughly 4 to 9% growth versus the same quarter last year. Despite the largest reconstitution in SCHD's history, the dividend growth engine appears completely intact. Watch 2. The removed stocks. A 284% payout ratio on one removed holding suggests a dividend cut may be coming for that company. If that cut materializes, it validates exactly why the quality filter removed it first. Watch for similar deterioration in other removed names over the coming months. Watch 3. Short-term price movement on additions. SCHD manages approximately $85 billion in assets. As those assets rebalance into the 25 new additions, that buying pressure could create short-term price bumps in newly added stocks. This is not a trading tip. It's a context for understanding why newly added SCHD holdings sometimes see brief price appreciation
appreciation immediately following Reconstitution. Your challenge this week. One action this week. Pull up your SCHD position or your dividend portfolio if you hold other funds. Calculate your current annual dividend income. Apply 10.6% annual growth for 10 years. See what your monthly passive income looks like at year 10. Then ask yourself one honest question. Is the amount you're currently investing going to get you to the monthly income number you actually need in retirement? If the answer is not yet, the Reconstitution you just watched is not just news about a fund. It is a reminder that the compounding engine is running. The only question is how much fuel you are putting into it. Post in the comments below. What is your current SCHD position? Or are you just getting started? Just those two options, current holder or just starting. If this video changed how you think about SCHD and dividend investing in 2026, subscribe to this channel. Every week, we break down investment strategies, portfolios, and financial decisions using real numbers and real data so you can make better choices with your money. Next week, we are going deeper. We are comparing SCHD against VYM and DGRO to answer the question every dividend investor eventually asks themselves. Which dividend ETF actually wins over 10 years? And which one quietly costs you more than you realize? Real numbers, real projections, no guessing. Subscribe, hit the notification bell, and share this video with any SCHD investor who has not yet seen what just changed inside their fund, because understanding what you own is the foundation of every good investment decision. See you next week.